All right. Hey, everybody. Welcome back to Ask a CPA, where we answer your hardest tax and accounting and finance questions. I am here with the one and only Russell Wallace, CPA. What's going on, Russell? How you doing, man?
Doing great. Doing great. So baseball season's about to start. So we just got all of our practice times out here. So looking forward to hitting the fields with the kids and life is good.
Nice. Did you play when you were growing up?
A little bit. It wasn't any good, but I haven't told my son that yet. So I'm hoping that he didn't get my genetics in this, and he's a little bit better than me. Right now, I think he's going to be, but he thinks I was great. So we're just going to let him keep believing that right now.
Yeah, I was awful at baseball growing up. They put me in right field or they put me on the bench. It was tough. It was a short career. Of course, I got on like the
Yeah.
best team, and they were like super competitive. And it was, they were like, "Who is this guy?" I would just swing at everything. I was afraid to get hit by the ball, and they made me quit the team right after that.
At least you gave it a good try. At least you gave it a good
Yeah,
try.
yeah, we won, but wasn't anything that I did.
Well, let's dive in here. We've got a couple of great questions from some folks coming in from the website. That's askacpa.co. So be sure, guys, and log in or sign in and ask your questions, and so that we can answer them for you.
Yeah, absolutely. Yeah, these are great. We've been getting a lot of questions through the website, so keep them coming. Yeah, these are great.
Well, Brett, I also noticed that you've got some great pictures behind you here. What is this? These are kind of new
Yeah.
here. So got some Pebble, Pinehurst, Augusta. I like it.
Yep. Yep. I have not played any of these courses yet, but maybe one day. I don't know
One
about
day.
Augusta. I'll probably never be able to play Augusta, but yeah, Pinehurst I think is public, right? I could go out and play, and so is Pebble.
Yeah.
So
Yeah.
those two are. There's still a chance.
There's
Still
still
a
a
chance.
chance. I feel like I should be better before I play a course like that, but you know, I'm sure there's some people I could find to go hack it up with.
Yeah. Hey, I'll go play with you. Let's go.
Thank you. Well, I make you look really good, so that's why I think you play with me because I,
That's
I
right.
make you look really good.
That's right. I feel really good about my game afterwards.
Yeah.
Well, cool. Well, here's the first question. We got Jennifer in Charlotte, North Carolina. I just bought my first home for $600,000 with my fiance, and we're trying to understand what tax benefits we qualify for. Can we deduct our mortgage interest, property taxes, and closing costs? And are there any homeowner tax breaks that most people don't take advantage of? Wow. The first sentence throws me for a little bit of a loop. I mean, you don't want to buy a house with your fiance. Let's say that up front. I think that's a bad financial idea. Just wait till you get married because yeah, it's if for whatever reason the marriage does not go through, it does not work out, now you have intertwined finances and all kinds of issues. Have you seen that happen before, Russell, in your tax practice?
I have not. I have not. And if anybody asked me, I would definitely give them that same advice that don't do it. Right? Just don't do it. And hopefully what Jennifer's saying here is that either she bought the house or her partner bought the house and the other one's kind of paying rent or something like that, right? So like maybe they're splitting the bills or something, right? So hopefully it's just in one of their names um and then they're just kind of splitting bills after that. So let's hope for the best and let's see if that's the case.
Yeah, we'll give them the benefit of the doubt.
Yeah, absolutely. So are there any homeowner tax breaks that most people don't take advantage of? I don't, if you're buying a new house, there's some energy efficiency tax credits that you may or may not qualify for. Those are things that the builder would definitely let you know about because, it's a big selling point. Hey, you buy the house, you're going to get, $2,000 back and that sort of thing and your taxes. So if they didn't let you know, there probably isn't. It's worth a call though, worth a phone call and just make sure there's nothing out there that maybe you didn't get or you missed in the excitement of purchasing that first house. But beyond that, most people know about the mortgage interest deduction, being able to write off your property taxes, those kinds of things. There's a couple of caveats to that. And in the last few years, or really since 2018, is that a sign that we're getting old, Brett, when you're like, hey, in the last couple of years, it's like 6 years ago. But, since 2018, what has happened is that they increased that standard deduction. So it used to be much, much smaller. They've increased it to, in 24, it's getting close to $30,000 now. And so your state and local taxes, which includes property taxes, your mortgage interest, which is now capped at $750,000 of the interest on $750,000 loan, and then charitable contributions. There's some other things in there, but they're a lot more rare than those. Those are kind of the big three. So those big three have got to be over $30,000 before you even get a deduction. If you're married filing joint, right? And so most people actually don't even take these deductions anymore. Now, here we have a unique situation, Jennifer, where you're still filing single, right? So one of the things that you can do is to then claim all of those deductions, the property taxes and all the interest on that house just on your return, right? Because your standard deduction is going to be just under $15,000, around $14,000. And so your standard deduction is going to be a lot lower. So it's going to be a lot easier to achieve that. Since y'all are together, and it sounds like you've kind of probably mixed your finances a little bit already. So then, just one of you claim all of that, and then the other one just take the standard deduction. And that's going to be a great way to maximize the deduction there for you. But any other ideas on that, Brett?
Yeah, I think it's a really good point that they're both going to be limited. So your mortgage interest, $750,000 of debt, and then property taxes are going to be capped at $10,000 along with your state and local taxes. So yeah, I would push them to one or the other. But as soon as you are married, if you're married by year end, I would most likely file married filing joint. I actually did a video on this not too long ago, whether married filing joint makes sense and in what situations it doesn't make sense. And it almost always makes sense to file joint unless you have like student loans or there's some specific reason you have IRS issues or something unusual that would keep you from wanting to file together. So yeah, unfortunately, having just having a house nowadays it's typically not enough for you to itemize. You have to be making significant charitable contributions or have like a FEMA disaster area or something, which a lot of people may have this year with what's going on in California and North Carolina. But yeah, I think it's a good question. I would recommend waiting to buy the house until you're married, just to make it a little more safe. But yeah, that's an interesting question. Yeah, I think Jennifer, I would file separately if you're still separate by year end and maximize those by pushing all the deductions to one of you and let the other one take the standard deduction.
Yeah. Well, next we've got Carlos from Miami and living in Miami. There we go. Bringing back, was it Will Smith, right? Back in the day. So we just had our first baby last year, and everyone keeps talking about tax credits for parents. How do we claim the child tax credit, and are there other tax breaks that new parents should know about? So what about you, Brett? What kind of ideas you've got here around some tax credits for children?
Yeah, I mean it's fairly straightforward. You get a $2,000 tax credit for having a child, and once you list them on your tax return as dependent, most tax softwares you put in their date of birth, their social security numbers, and what's your relationship with this child, and then it'll go ahead and calculate that credit for you. And there's a lot of proposed legislation to increase those tax credits. Who knows what's going to happen over the next year? It should be pretty interesting to see what the Trump administration puts forward, because a lot of the Tax Cuts and Jobs Act of 2018 are set to sunset at the end of the year, meaning going into 2026, they'll all go back, especially on like the estate tax is a big issue. These standard deductions, the standard deduction is going to decrease. A lot of these itemized deductions are set to sunset, and the child tax credit is set to sunset as well. So it'll be interesting to see what happens this year. I think they're going to be putting forward some pretty interesting legislative changes. What they've done so far has been pretty wild. So who knows what kind of wild changes they're going to be putting forward later this year. But yeah, what do you think, Russell? You following all these administrative changes?
Expect the unexpected, Brian. I think that's the best any of us can do is expect the unexpected. But yeah, I was just reading actually today that somebody put forth a proposal to increase, I think it's up to $4,500 per kid, and then a little bit extra for younger kids. And so going from $2,000 to $4,500, and then there's a little bit more for kids kind of 0 to 5, kind of that daycare age, giving those parents a little bit more of a help there. So I think that's great. So the other thing is the child independent care credit, right? So you've got that. So if you're paying for daycare, you've got that that you can use. One of the odd things about the child tax credit that I run into a lot is that people, they don't understand that it ends at 17, right? So I know Carlos here has got a new kid, but it's probably a long time before he's thinking about that. But for any of you folks who got some older kids, is that when your kid turns 17, then that credit, it doesn't go all the way away completely, but it drops all the way back down to $500. So from $2,000 to $500. So that's a big change.
Go get a job. They got to go get a job, man. They got to contribute. You lose $1,500. Come on.
There you go. Pay some rent around here,
That's right.
I mean, like we did when we were young, right? So, I mean, our parents, they made us work for everything that we had. Not like these young guys today.
That's right. What was your first job?
My first job was, first real job working for someone else, like a company, was McDonald's.
You were one of the many. How many? There's like a ridiculous statistic, like 40% of people or something that worked for McDonald's. It's like
McDonald's,
an insanely high number.
Yeah.
Let me look that up. It's really high.
So that's where you start, McDonald's University, right? So it is a wild number of people that McDonald's has trained as like their, maybe not first job, but a job. And even big executives, worked at McDonald's at some point and went through McDonald's use. So they've essentially, McDonald's has trained the American workforce.
Yeah, it says 1 in 8 Americans have worked at McDonald's.
Wow, 1 in 8.
Yeah, that's wild.
That's a lot.
It is a lot.
That's a lot.
My first job was bagging groceries at Tom Thumb. I was a bag boy.
Tom Thumb action. There you go.
Yep, carrying groceries out for old ladies. It was good times. Good times.
Yeah.
I worked there for a long time too, like 2 years or something. They never let me get on the cash register. I had to just keep bagging groceries. They didn't trust you. They knew better.
This guy's never going to be able to count.
Little do they know. Yeah, it was, when I was young, man, I was like 14, 15, the youngest you could possibly be to get a job. As soon as I hit that, I'm like, all right, I'm going. Let's go. I need to get some money. I need to start working.
Yeah, I had to, I forget how old I was, but I had to go get a form from the courthouse. And so like, you had to get this certified thing saying that your parents were saying that you could work and it was fine and all of that. So I was 14 or 15. I forget how old I was, but I had to go get something from the courthouse to work. My parents were like, look, we're getting you out of here as soon as we can. No, I asked.
What's your favorite burger at McDonald's? Are you a Big Mac guy?
I don't like any of those things, man.
No, come on, man. What about the McRib?
The quarter pounder. Quarter pounder with cheese and bacon, But I'm more of like if I have to eat something at McDonald's, then I'm going for the French fries, That's as long as they're fresh, and I'm just waiting. Like I just ask them, like, hey, I'm fine waiting. You can just go and cook something. That'd be great.
Yeah, their fries are ridiculous. Extra salt, man. That's good stuff.
Yeah,
fries in a milkshake. I'd prefer Wendy's spicy chicken.
Okay,
can't beat it, man. It's the best.
Yeah, I'm a Chick-fil-A guy, It's not a burger, it's chicken, I guess, right? Maybe that doesn't count, but...
God's chicken.
Yeah, that's it. They're just so nice, It's just nice. It's nice that people are nice,
Yeah, it is. I want to teach our team, hey, just be as nice to our customers as Chick-fil-A people are to their customers. Like, if this 16-year-old kid can, say yes, sir, no, sir. Have a great day. It's my
My
pleasure.
pleasure. Yeah.
Just be that nice, and every client will love us.
Yeah. Yeah. Well, Carlos, I hope that your kid grows up to work at some of these fine establishments like we did, some McDonald's, bagging groceries, those kinds of things. And until then, I hope that you're able to absorb some of these tax credits. And pay attention. We're going to keep you guys updated on what's coming out. So when the legislation starts coming out, we'll start having some conversations around that. But I do hope that the tax credits go up. It's something I think that really helps kids, or helps parents, and especially those with young kids. And so I think it's a good thing. I don't think anybody's upset about the child tax credit. So I think it'll stay in place. I hope it does, and I also think it'll increase. But
if it goes up, I may have a couple more kids. I mean, why not?
Yeah, just makes it worth it. Just that might be the plan, with the whole birth rate decline and all that stuff. That maybe that's their plan. Like, hey, let's make this profitable for people.
Jack it up. Let's go. Have some triplets.
I don't think at $4,000 a year, even, I don't think that's going to be profitable.
No.
It'd be a bad business plan. It'd be a really bad business plan.
Yeah, that's right. Well, cool. That was a great episode. Russell, Jennifer, and Carlos from Charlotte, North Carolina, down to Miami, Florida. We're
worldwide.
Well, we're U.S. wide.
Yeah.
Maybe not world yet. We'll get some international questions one day.
That'd be great. I'd love that. I'd have to do some research on that. If one of those came in. I'm not an international expert, but I would enjoy it. That's for sure.
Yeah, I've got a few clients that have come in recently that have had inheritance coming from outside the country and foreign assets that they're reporting here. Maybe we'll do a little foreign episode. It's pretty interesting, the different filing requirements and things that you see with foreign assets. But
yeah,
maybe next time. We'll see.
Maybe next time. It depends if we get some questions in. So, guys, if you've got some questions, be sure that you head over to askacpa.co. That's askacpa.co, and submit your question there, or in the comments of the YouTube or Spotify. And if you're on Spotify or YouTube, make sure you hit that like and subscribe button. And until next time, we'll talk to you later.
All right. Sounds good. Thanks, Russell.
Right. Talk to you soon. Bye.
See you.